Okay, let's dive in. Today, we're unpacking some pretty significant shifts happening right now.
Right. In real estate and finance, mostly.
Yeah, where the money's moving, potential tax changes, that kind of thing. Smart investing in this climate.
We've pulled together quite a bit of material.
The idea is just to cut through all that noise and get straight to what you really need to know.
Exactly. Give you the key insights without you having to wade through everything yourself.
So first off, something pretty interesting is this divergence in mortgage delinquencies.
Mm-hmm.
On the one hand, single-family homes. Things look pretty stable, actually ticked down a little in April.
Yeah, Fannie Mae was what, 0.57%? And Freddie Mac, 0.55%.
Right, those are the big players. Shows some real resilience there.
But, and this is the key contrast, multifamily is different. We're talking 1 to 4 unit buildings.
Yep.
Serious delinquencies there have climbed up to 0.63%.
Huh. Doesn't sound like a huge jump numerically, but context matters, right?
It really does. If you take out the sort of weird spikes during the pandemic, that 0.63% is the highest it's been since 2011.
Wow, okay. So what's driving that specific stress in multifamily?
Well, a huge factor is just the sheer amount of debt coming due.
Wow.
We're talking nearly $1 trillion in multifamily loans maturing this year.
$1 trillion. Okay, that's massive.
And with interest rates where they are refinancing that debt, it's proving really challenging for a lot of owners.
Right. So for you listening, this split isn't just data. It flags potential stress points in that market.
Which could mean challenges, but maybe also opportunities if you know what to look for.
Good point.
Yeah.
Okay, let's shift gears a bit from market stats to maybe policy. Potential tax changes?
Yeah, there's chatter on that front, some potentially good, some less so.
Okay, what's the potential good news?
Bonus depreciation might be making a comeback.
Oh, explain that quickly. Why is that powerful?
It lets you basically take much bigger tax deductions up front for certain investments, accelerates the write-offs, helps cash flow early on.
Got it. Okay, so that's the potential upside. What about the other side?
Well, there's also talk about possibly shrinking estate tax exemptions. That impacts longer-term wealth planning, passing assets down.
Okay.
And maybe a bigger one for many listeners, potential loss of some key pass-through tax perks.
The ones crucial for LLCs, S-Corp, those kinds of structures.
Exactly. Those benefits that currently help lower the overall tax hit by letting business income flow to the owner's personal return more favorably.
Right. This stuff is really critical then. These aren't small tweaks.
No, they could fundamentally change how you structure deals, how you manage wealth. You really need to stay plugged in.
Definitely. Okay, so we've got market health, potential policy shifts. What about like a really practical decision, buying new versus old property?
Yeah, how does that look right now, especially thinking about cash flow?
And here's something that might surprise you. In quite a few markets, new homes, they're sometimes costing the same, maybe even less than older resale homes.
Wait, less? How?
Once you factor in all the costs, specifically insurance.
Insurance. That's become a huge factor, hasn't it?
Huge. Premiums on older properties are just skyrocketing.
Yeah?
You've got aging infrastructure, outdated codes, repair costs going up.
Right. Makes insuring them way more expensive.
Whereas new construction, it's built to current codes, often uses more resilient stuff.
So potentially better insurance rates, maybe even incentives sometimes.
Exactly. Just completely flips the script on calculating cash flow.
Yeah.
You can't just look at the list price anymore.
You've got to understand how that property's age hits the insurance line item. It's essential for the real math.
Totally.
Okay.
Okay, last big topic. A question we probably both hear all the time.
Yeah.
Do you need an LLC for rental properties?
Yeah, the classic LLC question. And the answer really boils down to, it depends.
Depends on your goals, mainly.
Pretty much. The number one benefit, obviously, is liability protection.
Creating that separation, that shield between your personal stuff and your business assets.
Exactly. Crucial. But there can be drawbacks.
Like financing.
Sometimes, yeah. Lenders, particularly for smaller portfolios, might prefer lending directly to you as an individual. An LLC can sometimes add hurdles, maybe require different loan types.
Okay. What about taxes? Big myth here, right?
Huge myth. Just having an LLC doesn't automatically cut your taxes. It's not magic.
It's about how it's structured and taxed, correct?
Precisely. Are you taxed like a sole proprietor? A partnership? Did you elect S-Corp status? That's what determines the tax implications, not just the letters LLC.
So it's really a balancing act, weighing that liability shield against maybe trickier financing.
And understanding the real tax picture based on your chosen structure, it's definitely not one size fits all. Often needs professional advice tailored to you.
Makes sense. Okay, so quick recap. We hit the delinquency, divergence, stress, and multifamily, potential tax changes looming, the new versus old calculation being totally changed by insurance costs.
Right, and the nuanced "it depends" answer for setting up an LLC, weighing protection versus complexity.
So with all these shifts impacting everything from loan costs, insurance, taxes, here's maybe a final thought for you listening.
Given how fast things are moving,
How prepared are you to adapt your own approach, your investing strategy, your wealth management in this landscape? Something to think about.